Now let's bring in Richard Berner. He is co-head of global economics at Morgan Stanley. He was among the first economists to predict the recession. And Dick, now we can at least officially say it's over. We could also officially now have a double dip. You don't think that we're going to see one? Why is that?
No, I don't think, Matt, we're going to see a double dip for a few reasons. One of them is that growth around the world is still very strong, and we think that some trade tailwinds are coming to help U.S. growth in a modest way. That's one factor. Second, the decline in interest rates that we've seen lately, I think, is promoting a modest pace of mortgage refinancings and probably mitigating some of the foreclosures you talked about in your earlier segment. Neither one of those things is a panacea, however, and we are talking about a very moderate recovery, one that has slipped into somewhat slower gear in the second half of this year. We think something like 2 to 2.5%. Over the past month or so, the numbers have proved a little bit better, but frankly, it's still very modest in scope. And if a big shock came along, then that would be a problem.
Now, we are going to talk with Glenn Hubbard a little bit later, who wrote an op-ed in the New York Times suggesting one proposal to fix or at least to help out the housing market. You have a similar proposal. He uses, in fact, your research for his proposal. Right. Why don't you explain it to us? You think that the federal government can come through and quickly provide refinancing options to those people who are having a tough time because of the loss of a job, because of a bad credit score, et cetera?
Yes, they can. And here are the details, Matt. Something like 37 million mortgages out of the 55 million outstanding are actually guaranteed by the federal government. That means that the mortgage investor can put those mortgages back to the government at par, and the credit risk in those mortgages is already assumed by the taxpayer. So right now there are a lot of mortgage holders who can't take advantage of currently low mortgage rates, and that's because the housing GSEs and the originators are using appropriate origination criteria, appropriate for new mortgage originations, to qualify people for refinancing. And the problem there is these mortgages are already guaranteed by the federal government. The investor will lose nothing on the mortgage if there's a default. And we could benefit housing markets in general and the consumers who hold these mortgages in a significant way if we let them refinance and take advantage of lower rates. This would not be a bailout. It would not be a subsidy. It would provide benefits to, we think, as many as 18 million mortgage holders, and provide a cash flow benefit in terms of the refinancing of up to $46 billion on an annual basis.
Dick, you think, though, that consumers are actually doing a little bit better than expected as far as deleveraging, as far as dealing with this sort of thing. Is it really necessary right now?
Well, you know, we have, in the aggregate, I think consumers are doing better, because I think that when we look at debt service in relation to income, it has come down very significantly. And I think it's appropriate to look at nominal debt service relative to nominal income. And when we do that, we see that that ratio is down to just about 12.5% in the first quarter of this year. Given what we've seen recently with the trends of further declines in debt, further declines in interest rates, there's every reason to think that that ratio will be in what I think of as a sustainable 11 to 12% range by sometime later this year.
It had been at 14, and the 30-year average is about 12, right?
That's exactly right, Matt. And so the key to this is to think about the cash flow benefits to consumers from having lower debt service. It means that the credit that they have is more affordable, more supportive. And the work that I've done suggests that it's not just debt to income, which is also important, but it's also the debt service, the burden of financing or carrying that debt that's important.
Let me ask you quickly, Dick, only 30 seconds here. On your mortgage proposal, I would assume that the lender takes a hit in the form of the spread between the old interest rate and the new refinanced cheap interest rate. How do you fund that?
Well, the lender, the originator, holds a piece of paper that's going to be refinanced at a lower rate. So the income that would come from the new refinance mortgage, that's absolutely correct, would be lower. But there's no credit risk. And the fact is that, think about the alternative. If the lender holds on to that mortgage and the borrower really can't support it and cannot continue to service that debt, then there's a higher chance of default. There's a higher chance that with lower rates, it's going to be put back to the lender in any case. So the lender really doesn't lose anything here.